Nike stock just hit its lowest price since 2014. It's down 36% in the first half of this year alone. The CFO is leaving. China is collapsing. And the company just booked a $1 billion accounting benefit that made its earnings look like a turnaround when the actual business barely moved. If I were running Nike right now, here's exactly what I'd be doing differently. Nike is still, by a wide margin, the biggest sportswear company on earth. Tens of billions of dollars in annual revenue, the most recognizable logo in the industry, and a genuine moat built on decades of brand equity that Morningstar still rates among the strongest in all of retail. Elliott Hill took over as CEO in October of 2024, brought back after retiring from the company years earlier, specifically to fix problems that had built up under his predecessor. Hill spent nearly 3 decades at Nike before that retirement, rising up through roles the company's geographies and its consumer and marketplace organizations, which matters here. This isn't an outside turnaround specialist parachuting in with a generic playbook. This is someone who watched the previous strategy get built and is now the one cleaning it up. He's about 2 years into that fix now, running what the company calls its sport offense strategy, a deliberate return to sport first storytelling and rebuilding the wholesome relationships that had been damaged in the years before he arrived. The dividend has grown for 24 consecutive years, even through this entire rough stretch, and the balance sheet carries manageable debt. This is a company with real financial flexibility to fund a turnaround, not one fighting for survival. Before I talk about what's actually broken, let me just say this. This is not a company with a product problem. Nike still makes shoes people want to wear. This is a company with a strategy and execution problem, layered with a genuinely bad external timing on tariffs. Those are two very different diagnoses, and they call for two very different fixes. Under the previous CEO, John Donahoe, Nike made a strategic bet to push hard into direct to consumer sales, selling more through its own website and stores and less through wholesale partners like Foot Locker and department stores. On paper, that's a reasonable bet. Better margins, more direct customer data, less reliance on retail partners who could just as easily push a competitor's shoe instead. In practice, it damaged the wholesale relationships Nike has spent decades building. And those retail partners didn't just wait patiently for Nike to come back. They filled the shelves and the empty spaces with other brands. New Balance, Adidas, and Hoka all picked up real ground during exactly this window, building loyal customers of their own in the shelf space Nike voluntarily gave up. Elliott Hill has spent 2 years back in the road trying to rebuild those wholesale relationships. And there's real evidence it's working. Wholesale revenue actually grew 5% in a recent quarter, which is meaningful progress after years of deliberate retreat from that channel. But it hasn't been enough to offset weaknesses everywhere else. Greater China revenue fell 12% on a reported basis and 17% on a current neutral basis, as Nike deliberately pulls back on selling into a market where its inventory position had gotten messy. Too much product sitting with retail partners, priced in ways that were hurting the brand's premium positioning. Management has guided for continued declines in China through the rest of this calendar year as that cleanup continues. Converse, the canvas sneaker brand Nike has owned for 2 decades, fell somewhere between 32 and 35% in a recent quarter, down to around $264 million in revenue, and remains a serious drag on the whole portfolio with no clearly stated fix. Then there's a part that's really Nike's fault. Strategically speaking, the tariffs. The company has absorbed roughly $1 billion in additional costs tied to tariffs on imported goods, since an overwhelming majority of Nike shoes and apparel are manufactured in Asia. A class action lawsuit filed in May even alleges Nike raised prices by $5 to $10 on footwear and $2 to $10 on apparel, specifically to offset those tariff costs, while trying to hold on to a tariff refund without passing the savings back to customers who already paid the higher prices. And on top of the wholesale rebuild, the China pullback, and the tariff hit, the company's CFO, Matthew Friend, announced he's leaving in August, with David Denton, previous CFO at Pfizer and Lowe's, set to take over in his place, adding a leadership transition on top of everything else mid-turnaround. Put all of that together, all the chaos, and you get a stock that's down roughly 40 to 50% from its all-time high, sitting at levels last seen in August of 2014. So I'm curious, now that you know the problem and all the issues that Nike has had and all the mistakes they're making, Let me know in the comments below, how would you turn this around in Nike? Put that NBA cap on, you feel me? And let me know what you think down in the comments below. Here's where I want to slow down, because Nike's most recent quarter is genuinely useful in a lesson reading past the headline. On the surface, fiscal fourth quarter results looked like a breakout. Revenue of $11 billion, beating estimates, and net income jumping over 400% year over year, with earnings per share of 72 cents against an exception of well under half that. Shares actually popped 5% immediately after that report crossed the wire, before sinking to that 8-year low and after hours trading once analysts had time to actually read the numbers behind the headline. Except 52 cents of that 72 cents in earnings per share came from one thing: a nearly $1 billion recovery of import duties Nike had already paid under tariffs enacted through emergency powers that courts later struck down. Strip that one-time accounting benefit, and the company actually earned about 20 cents a share from running the actual business, in line with, not dramatically better than, the trend that had investors worried in the first place. The same distortion shows up in the gross margin number. It jumped about 9 percentage points to just above 49% on the surface, but almost all of that just came from the same tariff recovery. Strip it out, and underlying gross margin was roughly flat versus a year earlier, hovering around 40%. Outgoing CFO Matthew Friend himself described the operating environment plainly on that call, calling it an increasingly challenging environment where sell-through remains difficult. Not exactly the language of a company that thinks the hard part is over. For fiscal 2026 overall, analysts expect earnings per share of around $1.49, down 31% from $1.16 the year before. That's supposed to be through the roof. That's supposed to be the trough. Fiscal 2027 is projected to recover about 24% from there, with management itself guiding toward gross margin expansion beginning the second quarter of that fiscal year, as tariff mitigation and recovery from the roughest parts of this reset finally start to show up in the numbers without an accounting asterisk attached. Wall Street's price targets on the stock currently range from low 50s to a high $94 from Morningstar, which would imply upside of well over 100% from current levels. But that high-end target assumes several more years of mid-single-digit growth and mid-teens operating margins actually materializing, not just being promised in an earnings call. Before I get into the verdict and what I would do, make sure you sign up to the Raw Entrepreneur newsletter. I talk about stuff like this and even strategies that you can use to build your own business in this online economy, in this online world, while you're fully employed, single parent, whatever you are. There is a business model meant for you. If the company's operating at a high level, you can too. Get on the newsletter, it's free down in the description box down below. If I were running Nike right now, here's what I'd actually be doing differently, beyond just continuing the current playbook. First, I would stop letting quarterly earnings calls lean on one-time tariff recoveries to paper over the underlying trend, even if the accounting is entirely legitimate. Every quarter, the headline EPS gets inflated by a one-time item is a quarter Wall Street has to do extra work to figure out whether the turnaround is real and trust exactly when the company needs credibility. I'd rather report the ugly 20-cent number out loud than let a 70-cent headline get corrected by every analyst note the next morning. The market punishes surprises far more than it punishes honestly bad numbers it already expected. Second, I treat Converse as a decision, not a slow bleed. A subsidiary falling 30+% for multiple consecutive quarters inside a company that's also fighting wholesale rebuild and a China pullback isn't a brand that needs patience. It's a brand that needs a specific plan, whether that is real positioning, repositioning, a sale, a much smaller, more disciplined footprint. Right now, it reads like an afterthought and a much bigger turnaround story. And afterthoughts don't fix themselves. A company juggling 3 separate structural fires at once has to actually rank them. And right now, it isn't clear Converse has been ranked at all. Third, and this is on China, the 12 to 17% pullback is described as deliberate inventory cleanup. And that's probably the right near-term call, given how messy the channel has gotten. But deliberate or not, a market that size falling by double digits for multiple quarters needs a public specific re-entry plan, not just the promise that the cleanup is almost done. Investors can tolerate a controlled retreat. What erodes confidence is an unclear one, especially in a market this important to the long-term growth story. Fourth, I got another one. On the CFO transition, Bringing in David Denton from Pfizer and Lowe's is a real signal of financial discipline. Someone who's run finance at large, complex, consumer facing businesses before. I'd lean on him immediately and publicly to rebuild the credibility of Nike's own numbers, making a case explicitly and repeatedly for judging a business on figures with the tariff noise stripped out, rather than letting the market keep doing math itself every quarter. So, is a Nike buy right now a value trap or something in between? My honest read, it's a real turnaround with a credible playbook and a management team that's making the right structural calls. The wholesale rebuild is genuinely working, and Elliott Hill buying shares with his own money near the lows twice now is a signal worth noting. Not just a footnote, but the timeline keeps slipping. The tariff noise makes the numbers harder to trust quarter to quarter, and Converse and China are both still open wounds rather than closed ones. This is a stock for someone willing to underwrite a multi-year recovery and sit through more messy quarters like this one. Not someone who's looking for a quick catalyst. The brand is not broken. The execution and the timeline are still very much in question. And before you go, if you like stories like this, make sure you subscribe to the channel. It's completely free. It costs you nothing. Also, make sure you join the Raw Entrepreneur newsletter. It's completely free. Link in the description box down below. I'm Chris, and I'll see you next time.